Well, before we go lie on the beach and dream of all the new hobbies that we're going to do, there are a number of things that investors need to think about before they begin their retirement. Number one, how much can I take out per year without reducing my capital? The real number is about 4%. If you take out more than that, then you're at risk of depleting your capital over time. Best example I can give to you is if you picked up a newspaper back in 1990 and it was dated 2007, and you saw that the Mexican bolsa, the stock market in Mexico, was up almost 12 times, people would think immediately, wow, if I have $1 million, I can invest that and have $11 million in 17 years. And if I take out $75,000 a year, what does it matter? Because I'm going to be up 11 times what I started with. The problem is that along the way, that average return is not 100% a year. In 1993-94, when the Mexican peso fell, the stock market was down 40% and 26%. So anybody that invested $1 million with a $70,000 takedown every year would have run out of money by 1997. This is what's known as the flaw of averages. You could make, on average, 14% a year and still run out of money. Contrarily, if you make 14% every year, then you won't run out of money. So that's where the 4% number comes into play, that is the watershed limit to reducing your capital every year without running out of money for the rest of your life. The second thing is to think about large withdrawals. Money for a boat or a house or a luxury car or a big trip. It's very important that you take your money out when the market's doing well as opposed to when it's doing poorly. If you think of having $1 million in capital and going through that 2000 to 2002 period, which was the worst bear market since the 1930s, that $1 million becomes $600,000 and it requires a 60% return to get back to break even. Now, if you take out $200,000 when you've only got $600,000, that $400,000 has to rise 150% to get back to break even. So it's very important that people remember that when they're taking money out, to try and do it when the market is strong as opposed to when it's weak. The final thing that people have to be focused on is, what is my asset mix going to be in retirement? There's a fallacy out there that you need to have more fixed income the older you get. And we don't believe that, simply because inflation is the biggest detriment to retirement portfolios, and it's important to have equities, even if you're 90 years old, in your portfolio to offset inflation. Investors need to be thinking about real returns after tax and inflation when creating their asset mix. And once you have your asset mix in place, what percentage of stocks do I want to have? What percentage of bonds do I need to reduce risk, to provide for that drawdown every year so that my capital is not depleted? Then put that plan in place and stick to it.